Good afternoon. I'm going to highlight some information, some key terminology, and key concepts from Chapter 12 that I think are important. I also want to note that I hope everyone is staying safe and that I missed the class and the interaction with all of you. This chapter is dealing with accounting for partnerships, and some of you mentioned you want to start your own businesses and things of that nature. Mr. Jones and Miss Sally spoke about starting their own business, and I know Mr. Moore also talked about doing some real estate. And so, going over this chapter, reading this chapter in depth will probably help you a lot. So getting started, learning objectives, learning objective 1 and 2. One is to discuss and account for the formation of a partnership, and 2 is to explain how to account for net income or net loss of a partnership. Partnership, an association of 2 or more persons to carry on as co-owners of a business for profit. Types of businesses: small retail, service, or manufacturing companies, accountants, lawyers, and doctors. Association of individuals, a legal entity, accounting entity, and net income not taxed as a separate entity. Mutual agency, the act of any partner is binding on all other partners, so as long as the act appears to be appropriate for partnership. These are all characteristics of a partnership. Limited life, the dissolution occurs whenever a partner withdraws or a new partner is admitted. Dissolution does not mean the business ends. Unlimited liability, each partner is personally and individually liable for all partnership liabilities. And co-ownership of property, each partner has a claim on total assets. Claim does not attach to specific assets. All net income or net loss is shared equally by partners unless otherwise stated in a partnership agreement. Partnership agreement is very important, and it's going to be discussed in detail coming up. Organizations with partnership characteristics. Special forms of business organizations are often used to provide protection for unlimited liability. Special partnership forms are limited partnerships, limited liability partnerships, and limited liability companies. In the LLP, all partners have limited liability. There are no general partners. Also, with that being said, a LLC, the limited liability companies, are the most popular form. So regular partnerships. Major advantages: simple and inexpensive to create and operate. Major disadvantages: owners, partners, personally liable for business debt. LTD or LP, limited partnership. Major advantages: limited partners have limited personal liability for business debt as long as they do not participate in management. General partners can raise cash without involving outside investors in management of business. Major disadvantages: general partners personally liable for business debt, more expensive to create than a regular partnership, and suitable for companies that invest in real estate. LLC, the most popular one. Major advantages and major disadvantages. Owners have limited personal liability for business debts, even if they participate in management. Major disadvantage: more expensive to create than a regular partnership. So advantages and disadvantages of partnerships. The advantages are combining skills and resources of 2 or more individuals, the ease of formation, freedom from governmental regulations and restrictions, and the ease of decision making. The disadvantages are mutual agency, limited life, and unlimited liability. A partnership agreement. It should specify relationship among the partners. The names and capital contributions of the partners, the rights and duties of partners, basis for sharing net income or net loss, provisions for withdrawals of assets, procedures for submitting disputes to arbitration, procedures for withdrawal or addition of a partner, rights and duties of surviving partners in the event of a partner's death. Partnership agreement is very important, especially in accounting, to help account for the business. So here we have an illustration, Rolf and She. So assume that Rolf and She combined their proprietorships to start a partnership named US Software. Rolf and She have the following assets prior to the formation of the partnership. So here to give you an illustration of their assets before combining. And so cash, equipment, accumulated depreciation, accounts receivable, and allowance for doubtful accounts. They give you the book value for both individuals in their companies and the fair value. So we're going to prepare the journal entry to record the investment of Ralph. Um, I noted here that you're going to use the fair value. So if you look back, you're going to always use the fair value when you're combining companies. And so cash is going to be debited for $8,000. You're going to debit equipment for $4,000 and credit his capital account for $12,000. For Shia, you're going to debit cash for $9,000, debit accounts receivable for $4,000, credit allowance for doubtful accounts, and credit his capital account for $12,000. Learning objective 2, explain how to account for net income or net loss of a partnership. Dividing net income or net loss, closing entries. You close all revenue and expense accounts to income summary. You close income summary to each partner's capital account for his or her share of net income or loss. You close each partner's drawing account to his or her respective capital account. In a college university setting where you don't have owner's capital, we close all revenue and expenditures to the fund summary, fund account. And basically, revenue and expenditures are temporary accounts, and that's why they get closed out. Assume that AB company has net income of $32,000 for 2020. The partners Arbor and Barnett share net income and net loss equally. Drawing for the year were Arbor's $8,000 and Barnett's $6,000. The two closing entries are as follows. And so here in this scenario, they're telling you, I guess based on the partnership agreement, they're 50-50 partners. And so they're both going to get 50% of half of the $32,000. And during the year, they both withdrew some money from the company. And so this is their T accounts, where you notice they've credited $16,000 to both of their capital account for their revenue, for their income, and they already have a balance in their capital account that goes forward, a balance of $47,000 for Arbor and a balance of $36,000 for Barnett. The closing entry, journal entry, is going to be a debit for $32,000, which is the income, a credit to Arbor's account for $16,000, and a credit to Barnett's account for $16,000. And if you notice, that's 50% of the $32,000. That's the first entry. The second entry has to do with the drawing account. During the year, they withdrew funds, and so their drawing account were debited for $8,000 and $6,000. Now you're going to credit them for $8,000 and $6,000, and you're going to debit their capital account for $6,000 and $8,000 respectively. And so here you have a debit for $8,000 to Arbor's capital account, a debit to Barnett's capital account for $6,000, a credit to the drawing account, and a credit to Barnett's drawing account to zero out the drawing accounts. So if you notice here, the accounts are now zeroed out. This is their balance in their capital accounts at the end of the year, 55 and 46. So dividing net income or net loss. And so income ratios, partnerships agreements should specify the basis for sharing net income or net loss, typically income ratios. And so this is basically discussing the different types of ways you can break up the income in the company. And so they have a fixed ratio, a ratio based on capital balances, salaries to partners, and then the remainder on a fixed ratio, interest on partners' capital balances, and the remainder on a fixed ratio, or salaries to partners, interest on partners' capital, and the remainder on a fixed ratio. So here we have an example. Sarah King and Ray Lee are co-partners in the Kingsley Company. The partnership agreement provides for salary allowance of $8,400 to King and $6,000 to Lee. Interest allowance of 10% on capital balances at the beginning of the year. The remainder equally. So capital balances on January 1st were $28,000 and $24,000. Partnership net income was $22,000. The division of net income is as follows. So the instructions want us to prepare a schedule showing the distribution of net income, then journalize the allocation of the net income. And so here's the schedule showing the distribution of net income. So their salary allowance, remember they both got the net income was $22,000. They both received a salary allowance, $8,400 and $6,000. Interest allowance on partners' capital. So they both were allowed 10% interest allowance on their capital invested in the company. So here's $2,800 that represents that, and here's the $2,400 that represents Lee's. So the total interest allowance was $5,200. So here you have total salaries and interest. So altogether, they in recognizing the salary and interest, they recognize 19,600. So you only have 22,000 in total. So you subtract out the 19,600 out of the 22, because what you have left is the income part. And so from the income part, then they're going to split that 50-50. So you have $1,200 going to Sarah King and $1,200 going to Ray Lee. So now the total division of net income, Sarah King's is 12,400 and Ray Lee's is 9,600. The total comes back to 22,000, which was your net income in the very beginning. In journalizing this, you're going to debit income summary. You're going to credit capital for 12,400 for Sarah King and credit Ray Lee's capital for 9,600. And if you look back, that's exactly what's here in the schedule. 12,400, 9,600. So here they're giving us an example. They're telling us assume that the net income is only 18,000 instead of 22,000. So in that situation, the total salary stay the same, the 11,200 to 8,400. The remaining income, you're going to subtract the 19,600. What is the total salaries and interest? Same from before. Now you're going to subtract the 19,600 from the 18,000. And then allocate 50% of that. And what you notice, it's negative. And so that's because there's a loss. And so they're both going to share in the loss, which reduces their capital account. And so the total still comes back to 18,000. Now Sarah King is 10,400 and Ray Lee is 7,600. So this is an illustration of Kingsley Company Partners capital statement for the year ended December 31st, 2020. And they're just giving you an example. Capital January 1st, additional investment, net income, what they allocated out to 22,000, less what they drew out of the business. And now this is their ending capital at December 31st. Kingsley Company balance sheet partial, December 31st, 2020. Total liabilities assumed amount 115,000. Sarah King, so this is the owner's equity area. Sarah King's capital 35,400. Ray Lee's capital 28,600. Total owner's equity 64,000. Total liabilities and owner's equity 179,000. The balance sheet for partnership is the same as for proprietorship, except for the owner's equity section, because you've broken it out amongst more than one owner. So another illustration, Lee May Company reports net income of 57,000. The partnership agreement provides for sales of 15,000 to L. Lee and 12,000 to R. May. Salaries, not sales. They will share the remainder on a 60-40 basis. 60 to Lee. Lee asks your help to divide the net income between the partners and prepare the closing entries. So here they're not sharing the income 50-50. It's 60-40. And so this illustration, the division of 57,000 net income is as follows. The salary allowance is 15,000 and 12,000, which totals 27,000. The remaining income, where you take the 57,000 and subtract out the 27,000, and then which is the 30,000, and it's going to be distributed 60-40. 60% going to Lee, 40% going to May. Total remaining income 30,000. Total division of net income is going to end up being 57,000, which was the original amount. 33,000 to Lee and 24,000 to May. The journal entry is as follows. Debit income summary for 57,000. You're going to credit Lee's capital account for 33,000, and you're going to credit May's capital account for 24,000. That's it.